All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Market's been open here about half the day, and it's been a very interesting open and very interesting across the board in terms of some of its implications. We saw the market gap up, and this is one where on Friday, the market sold off into the close, and I even put in my note, look, we're not seeing anything market changing or really that different. Whether it rallied 10 points into the close or fell off into the close, there was nothing in this close that would suggest what would happen going forward. Okay, and that's that is the case, but today it's not the case. Today, okay, holiday season over. All right, great. We have traders coming back, investors coming back. Yes, slowly, but are there some implications into what's going to happen going forward? And today we saw the market gap up as Asia was strong overnight. And then you can see just as Europe is opening, I mean, this is a big rally as Europe's opening. And in fact, the S&P is not higher right now than it was overnight at the height or just after Europe had opened. In fact, S&P futures volumes were really high, for this time period, and a very bullish move. And one that, rightfully would give investors some confidence, to come in to buy up this open. And that's what we saw. Investors came in, they bought up this open, and, they bought up, some individual stories. They bought up some oversold, but they're not chasing. Right? They're not chasing in any major way here. And we can see that, we saw that initial buy up, and it's just kind of been, up and down chunky here since. The volumes overall today, they're up compared to Friday, but they're still really light. And Monday typically has lighter volumes, so, it's not uncommon to see lighter volumes, during this time. But these are a little lighter than I would have expected. And so what are the implications there? Well, it tells me that we're not seeing, something really massive happening. In fact, compression is probably what we're going to see in stocks here throughout the day. Now, we'll probably see a move into the close or something like that. But as far as, throughout the rest of this day, we'll probably still see some more compression, in things and as they go. Now, this morning, I did get out of my Under Armour when it was up about 70 cents. This stock opened up, Friday was kind of a day for it, right? Just implied volatility eroded. And, today the implied volatility eroded on it. In fact, I'll speak to that a little bit more. But then Under Armour made this shot up here to 22.20. I decided to take it and move on. I don't have a great technical reason or, really big thesis with it. I just, took it and left. Some concerns about the market, some concerns that, about implied volatility are probably what are weighing more than anything and why I took it. Now, I decided to hold FedEx, and this is just a pure exposure thing, right? If FedEx were worth what was, Under Armour was worth $1,000, $1,100, right? If FedEx was worth $1,100, I would have pulled it off here this morning, right? But it's worth $200. And so it's a little bit of a different exposure decision. And it's one where, do I like what's happening? No, I don't. It's one of those where the implied volatility has crushed this option, more than what the delta has. And, you add the time decay and, it's moving like an option moves, but it sure highlights the risk of some of options out there in the market right now and that implied volatility crush. And FedEx is kind of a little bit of a poster child here for it. But this is one where, okay, $200 exposure. All right, I need a pretty big move for it to go. But this is also something where I look at the broader market and I go, okay, you know what? This is a market where this week we could see the market up 80 points by the end of the week, right? We're up 30 today. That means there's still maybe another 50, maybe even 60 points left higher in the market potentially. Now, I think today increases the downside potential as well, that downside risk as well. But, if we see the market continue and just kind of track on higher, I would not be surprised to see it up to 272, 274 on the SPY, right? Okay, I have $200 into some FedEx. If the market does that, FedEx is going to move up. It's going to do okay. All right, for $200 risk, okay, I'll hold that. I'll keep that, right? But I was not willing to do that with Under Armour with that same risk. And one of the reasons is if Under Armour were to pull back even a little bit, the implied volatility crush from a small pullback and a little bit of flat would be tremendous. Now, this may still be something I get back into by the end of the day, and something that I am considering. I will do a different option if I do, but overall, this is just one where decided to take the gain here this morning. It's a nice little pullback here, cents, 20 cents. Nothing that big, but a nice one in terms of if I want to go and re-enter and get back in. Sets up fairly well here. So anyway, that's where I'm at. So with the challenge, I'm in cash and in about 200 there on FedEx. Now, I was asked this weekend about implied volatility, and Michelle forwarded it over to me. And so, implied volatility is one of those concepts that's kind of nebulous out there. We could go and define it and talk about it and everything else, but the reality is how it works and how it trades, will vary from day to day. Will vary based on market conditions and, how excited investors are, how fearful and panicked they are. It will ebb and flow. I did go and I pulled out the Vegas on my 3 trades for this challenge so far, and the Vegas here totals $700 in implied volatility loss. Right, so the challenge is about $3,000 right now. Right, we've had two winners, one loser. So the challenge is about $3,000. But the implied volatility loss on the options, if we look at all 3 of the options, Pepsi, Under Armour, and FedEx, and yes, there's a delta gain or delta loss in the case of FedEx. We factor that delta in. We factor the time value and the time decay in, right? And then we look at what those options maybe should have done with the prices they hit and what they actually did. We're talking about almost $700 worth of implied volatility, and that's a massive number, right? And that's not something that, it's not something that's surprising. That's not something I look at in hindsight and go, oh, man, I did something wrong or anything of that nature. No, that's the risk of buying in a high implied volatility market. Right? That's the risk of stepping into options when the VIX is elevated, because when that VIX starts to drop, that IV is going to hit you. So you better have your stock make a move that's pretty serious in order to overcome it. And so that implied volatility risk is still high. It's obviously lower across the board today than what it was on Wednesday or than what it was on Friday. But that is still an element that has to be taken into account, has to be realized, and factored in when looking at things. Okay, one of the trades I'm looking to put on for the challenge is some VXX puts. Right, and VXX puts would basically be a bet on what? That the implied volatility contracts. And for me, I like to play VXX puts when the average true range of the market starts to fall. Right. It's not something where I look at it and go, oh, well, when the market starts to go up or market starts to go down and play anything directionally, right? But when the average true range on the market starts to fall, that's when we tend to see VXX take steep drops, right? Here's the average true range on the market here. It has been dropping, and it has dropped over the last several days. It is still high, but it has been falling, right? It's something where the average true range could still go up. We could still see some monster moves out there. But if we start to see this average true range come back to normal, make one of these types of moves right here, what's going to happen to the VIX, right? What's going to happen to the VXX more specifically, right? And if we look at the VXX, and I'm just going to mark this, mark this time period of drop right here in the SPY. Right, and if we come and we take a look at the VXX during this time period, you can see the VXX went from up here around 50 to down here in the low 30s during that time period. And it doesn't mean the VXX doesn't have pops and all of that, but when we see the average true range start to drop on the actual market itself, we tend to see the VXX really start to grind on down. Now, one of my issues with the VXX has simply been the option values, right? And, are the option values, are they going to pay? And, I could go buy these 37s here for $2, and I basically need the VIX to have, 2 days like today to be in a decent position. If we look at the Vega here on them, the implied volatility per point, it's 3 cents. You say, well, that's not that big of a deal. Well, if the implied volatility on the VXX option starts to really drop, we can see it drop 17 to 20 points. So that's 60 to 70 cents on my option. Well, that's 30% of my option subject to implied volatility loss. You say, well, if the VXX goes down, doesn't the implied volatility go up? Well, for most stocks, yeah. For the VXX, no. So I could come in, I could say, well, you know what, great, I could buy a normal option. There's 30% risk just due to implied volatility. And so I need the direction to be strong and strong in my favor. And I have to say, okay, do I think the 30 level is possible? And while, yes, it's possible, I don't look at it as highly probable, and in the time frame of that option. And so I'm not getting good value there with that, and that is something that is real across the board out there, and is something that has to be taken into account. Now, there's some things that are outpacing it on a day like today. They're going to outpace the implied volatility. Something like a Bank of America, right? I mean, if we look at these 27s and we look at what they were on last week, right? They were going for 70 cents into the close, and all right, they're at 90 cents right now. Okay, there's some movement there. There's enough movement in the stock to counter. So it's not one where I look at and say, man, just stay away from options because they're all terrible and they're all overvalued and they're all blah, blah, blah. But it is one where I look and I go, okay, I've got to be careful. I can't take too much of that risk. And with Pepsi, with FedEx, and with Under Armour, the total implied volatility loss on just those 3 trades. And remember, I'm not putting a ton of money into each trade, but the total implied volatility loss on those is about $700. Right? Now, I could go deeper in the money. I could go longer term option and mitigate that, but then I lose some delta. I lose some of the risk or the reward components associated to it, and we're not going to fool ourselves by thinking that longer-term options aren't going to have implied volatility, loss associated here with them. So that is a major factor out there, and will continue to be. It is not something that I look at and say, well, this just prevents trades, but it is something that I have to look at from an exposure standpoint and understand. I like Chipotle Mexican Grill. I think it ultimately goes higher. But this is a really good example of a stock where, okay, I could go buy Chipotle with Bollinger Bands contracting, right? And yeah, it could go a little lower, a little higher. But what's going to happen to the option values as Chipotle consolidates and compresses? I mean, what's going to happen to the option values? They're going to get crushed. And so if I do go buy a call and then it drops $8-9 and I got to hold it to come back, by the time I hold that, it's going to be pretty worthless, right? And that risk is out there across the board and across sectors. And you take a look at something like a Microsoft, and it doesn't have the same compression on the Bollinger Bands associated to it, but it is still one that what's going to happen to the option values? If 4 days from now it's sitting here around 105, 106, right? Now for this challenge, I'm trading a little more short term. Right, so I'm only concerned, more with my hourly, and I want my daily to kind of match, but I want some sort of strong hourly. This morning it gapped up. We saw the CCI come up here to above 200. I'm not going to chase into something at that level. And we saw that with a lot of things here this morning. Now, one that I talked about last week, and I strongly considered being a buyer of on Friday, and I said, I'll wait for a gap, but it just gapped too much today. Was Las Vegas Sands. And you can say, well, it gapped to 52. We could have gotten in there, and it was up another 250 from there. But if you watch the options, that wasn't feasible. That wasn't realistic, but for me now, it's moved too far. It's off my list as far as looking for an entry. It's moved too far. It's gone 49 to 54. It's gone up 10% in 3 days. Great. It's one that I expect to ultimately go higher, but it's one where I need to be buying on a pullback, not on this uptick here with it. Even though it has some strong, nice little daily components associated to it. But I'm not convinced that puts aren't the way to go for a few things out there. And one of the reasons I say that is because we're not seeing a big change in the market internals today. We're not seeing a change in Apple. This has been a market that as go Apple, so goes the market. Now, I'll grant you, today Apple is red and the market is green. But if you look at what the market's done since the open and what Apple's done since the open, here's Apple on the open, gaps up, right? Gets bought up a little bit and has bled and has rallied here just a little bit, right? Well, look at the market. What did the market do? Maybe, if it wants to load. Here we go. So it opens up, right? Gaps up. And it didn't have that sharp down and then up, but had that same rally at the time of Apple. Chunk. Same type of chunk lower as Apple. And, here in the last 30 minutes, same type of rally as Apple. And, this is a market that is still, in my opinion, highly triggered to Apple. And it is one where, we could talk about, we talked about the whys last week of all of that. But it is one where when I look at the market and I see Apple trading in the red, man, that's a tough market to want to buy. It's a tough market for me to want to buy, especially when the implied volatility risks are still very high. So I look at it and I go, okay. Well, if stocks fall, what's going to happen to the implied volatility? Well, the implied volatility is going to go up. Is Apple signaling that, some of these rallies are just some dead cat, low volume Monday morning bounces that are going to get sold into? Perhaps, right? Perhaps. But there's nothing in the price action here this morning to say, hey, you know what? It's time to go. Let's go. In terms of put options. In fact, in general, the price action is quite the opposite. Now, there is some turmoil continuing to go on with Brazil. We see the EWZ down big here. This is one where I still think path of least resistance in the short term is going to be lower. This could probably be picked up for 35, 36. But you take a look at something like a Vale, which has just fallen off the proverbial cliff here in the last week. Down, really, just getting smoked. You look at PBR, it's fallen off nowhere near to the same percentage of what its gain was in September and October, but still to the same percentage as Vale. So we see a lot of, we see still some turmoil going on there. Banco Bradesco getting hit here today pretty hard with some of the Brazilian stuff. So I go, okay, do I go take advantage and get into some Banco Bradesco, puts and look to play it lower? Do I look at some of this rally and say, well, you know what, here's a Nike, and yeah, bullish on it. But it snapped back to the 7-day moving average. This is where we tend to start to see things fall off. And I think there's a pretty good case for that to be made. But one of the things that tends to happen when we get these bounces is that if it's going to fail, if it's going to push lower, it's going to break below today's lows, right? It's going to break below today's lows. And something like a Nike, right, with the stochastics rolling off of 20, tends to be a bullish signal, right? I'm bullish on the stock. But if it were to break below this 72.27 here, tomorrow, not today. This is not a today type of thing. But if we were to break below 72.27 tomorrow, that'd be a pretty good sign that, you know what, it's got another leg lower. And there's a lot of stuff out there like that in the market today, and where you can look at it and say, okay, you know what, this is a nice bounce. Maybe it needs to be sold into. Pepsi, I think, we saw this topping candle here in Pepsi, and, we talked about it. I said I'd like to sell into a bounce. It hasn't bounced enough yet for me, but it may not. This may be something that just ultimately breaks down. Well, here's today's low. Great, today's low breaks. I can go after it and look to take advantage of it on the downside, and that's what that's what I'm looking at with some of the stocks that are on my watch list here. My apologies, something just that was pretty interesting, but anyway, my apologies for that. But overall, as we look at this market gap, it's not changing the internals. It is one where I do think the market path of least resistance without a negative catalyst is higher. One small negative catalyst, and we could be talking about the flush risk on the market being significantly lower. And you see me circle this 250 level? I think that level comes into play if we get a negative catalyst, and it could be a matter of 2 to 3 trading sessions for the market to get down there. And you know me, I'm not an alarmist. I'm not, sky's falling type of a thing. And, I do think we've saw some decent bottoming action right here. But the fact of the matter is the way that the market is traded, if we look at this as just normal waves, lower high, lower low, we're talking about 250 coming into play on the market, and we're talking about a market that breaks the levels from last week, that breaks this overall level. We're now talking about a market that's negative on the year. Fund managers having to adjust to that. That spurs into some more short selling, and could spark that next move, precipitously lower here of about 160 points on the S&P, and so that is something that I'm looking out for. And concerned that maybe we see that, but we've had a little bit of these bounces come into play so far. So far so good, but the lows of today start to break. And, I look at it and I say, market has about 160 points lower in it. How would I play it? Well, probably with a market ETF. The implied volatility on those is coming down nicely here today. They're still kind of insanely valued there. But, when it comes to that, there's probably not going to be much differentiation. So probably play it with anything and, go from there. I look at something like a Caterpillar, right? Which has had this nice little bounce, and it's now kind of had this, fading wedge here, which, these can oftentimes be nice little bullish consolidation patterns. Excuse me. These can often, excuse me for that. These can also be oftentimes be bullish consolidation patterns, and but nothing breaking out of that pattern here just yet. But if we start to see Caterpillar break below last week's lows, see it free fall back into the 110, 105 area, I think is a risk factor here for it. And do I think it's fundamentally justified? No, I don't. But is it a technical risk factor that's out there? Absolutely. And so far, the way this bounce has materialized in the market, it's on low volume. It's without Apple, and it's one where there is still a very type of nervous nature out there in the market. And so while, yes, I'd love to be a buyer, being a buyer is one where, okay, those implied volatilities, you got to factor those in. Would I like to be a seller? Yeah, I'd love to buy some puts, but I got to get some confirmation, and that's probably not going to come here on a day like today. If you'll notice this morning's open, you take a look at stocks like Verizon, right? Nice move on the open. AT&T, nice move on the open, right? A little more defensive type names. You take a look at a Boeing, right? Not money not going in there, right? They're not. We're not seeing money going into some of these aggressive industrials that should be out of the water. Should be off and rocking and rolling if the market's ready to zoom, and we're not seeing it here so far. Doesn't mean it's not going to happen, but we aren't seeing that today. What we are seeing is a lot of oversold bouncing and things like a Halliburton, or a ConocoPhillips or something of that nature here in the energy space, and a little bit of positivity in some of the consumer names like an Under Armour that we saw here today. But anyway, those are some of my thoughts here as I kind of look at the market today, as I kind of look at the trades for the challenge and where things sit. A big part of me would love to kind of be able to wait until tomorrow morning, and if we see the market weaken tomorrow morning, buy some puts into that. And if we see the market strengthen, I do think there's a pretty good argument to be made for another 3, 4, 5-day rally. And so I look at this market, and yes, there's compression risk in the options, but it is one that the next 80 points probably have nothing to do with the fundamentals. The next 80 points probably have everything to do with the next catalyst, and whether that's sparked from trade war, Fed, Trump, Europe, whatever it might be. The next 80 points are probably a catalyst-driven thing and have nothing to do with the long-term trend and long-term trend development or long-term trend, breakdown or rally, but will affect the markets to that tune of, another 50 points higher after today, or potentially another 160 points, lower here in the markets. All right. Alrighty, I'll be watching some of the close here today, seeing, how things close, where they're at. But I don't have something that I'm just drooling over and saying, man, I really want to get into this right here, right now. Again, I pulled off my Under Armour, and I'll continue to hold my FedEx here and go from there. Again, thanks for hopping on. Hope you had a fantastic holiday weekend, and we'll talk to you later. Take care.